Hey there, this is Ike Hoffman with Tactica Real Estate Solutions. This specific video is going to cover the turnkey valuation function of this model. This model is special because it can look at turnkey properties that are ready to be rented from day one. It also can handle fix and flips, or if you find a property that you want to fix up and hold for the longer term, it can handle that as well. So again, this is going to be a quick video covering the turnkey portion of the functionality. Feel free to check out the other video as well, which will cover the fix and flip and fix and hold. So when you come into this model, you're gonna start out on the investment summary tab, and this is where a lot of the assumptions are made, and also where you can see the main facets of the deal, specifically return metrics, the financing, the costs, things of those nature. Depending on what strategy you're doing, you're going to select between turnkey, fix and flip, fix and hold. You choose right here. You'll notice off to the right, there are some workbook rules. Do not add or delete any rows anywhere in the workbook, and do not add or delete any columns anywhere in the workbook. I have these notes, or these rules I should say, because I use macros in this workbook to improve your user experience. Basically, everything in here, everything is included in this analysis, the turnkey, the fix and flip, fix and hold, but I hide rows and hide columns depending on what you select right here. So if I click fix and hold here, you'll see that the whole interface of this dashboard transforms, and you can see all the fix and flip and fix and hold metrics. So if you do delete columns or add rows, that can mess up the macros because they're all functioning right now statically with the current layout of the Excel workbook. So now that we're clear on that, let's start explaining each analysis block here. So up in the upper left-hand corner, you have your acquisitions assumption. So everything that's a brown text cell, that's your responsibility. Black text is either going to be a formula or label, and you don't need to worry about it. So you're obviously going to need to enter in a price in the price tab, and then closing costs. So this is a formatted cell. You can see up here it just says 3%, and then I formatted it to say closing costs after, so you can adjust closing costs as a percent here, 1%, 2%, 3%, whatever you feel is accurate. Below it will show you the equity required. The general property information's in the middle. This is where you're going to type in the address, the city, state, units. So this specific example I'm going through today is a duplex. You can see you can do anywhere from 1 to 4 units. 1 would be a single family home. And then project closing, you can enter in as well. And then the strategy, we already talked about that, but that's where you would select turnkey, fix and flip, or fix and hold. There's some cash management off to the side. This is more prevalent when you're doing a fix and flip or fix and hold strategy. So when you're doing turnkey, it's just going to show you how much cash you need to close, and if you have any capex in the budget, that will show up here as well in the red. That's a separate tab that we'll get to shortly. You're going to plug out your financing in the conventional financing section. After you do that, you can see return metrics. So you can toggle how many years you want to hold the investment for, and you can see how different metrics will change. Obviously, your cash on cash years 1, 2, and 3 will stay the same, but the IRRs and equity multiples will change depending on how many years you're willing to hold the investment. Off to the right, I have a rent and gross rent multiplier comparison. This is just to make sure that your assumptions over a longer term hold are in line and you're not being too aggressive on your appreciation assumption. So you can see right now in the model going in, you'd have a gross rent multiplier of 8.33. And then when you sell it in year 4, it'd be 8.25. They're pretty close to each other. You control annual appreciation down here in cell F44. So if you are plugging in a purchase price of $250,000, that's going to grow at 2% each year. And then when you sell it 4 years from now, you're going to get $270,000 for this investment. So if you went like 10% annual appreciation, you can see the gross rent multiplier jumps up. It's way higher than it is going into the investment. It's a nice safety net to make sure you're being reasonable with your appreciation assumption. So I'm going to put that back to 2%. You can also control the cost of sale. So this would be, your deed tax, paying a realtor, potentially legal fees. I have 6.5% in there. All the residual assumptions will get summarized. You have cash flow summary as well. So you can see the NOI each year, the cash flow after debt, and the debt service coverage ratio, and then finally in the bottom left-hand corner, you'll have sources and uses. So you can see the costs, how much loan you'll have, and how much equity you would need to bring to the table to close. Then the model also has a Capex plan. Honestly, the Capex plan is much more prevalent for the fix and flip or fix and hold scenario, but you might be buying a turnkey property that needs a little bit of capital. It's not going to need a lot maybe. Perhaps you need to do some landscaping or some exterior stuff or new appliances. You would enter that in here. Make sure you check out the other video. I'm not going to get too in the weeds on it on this one, but this is a very powerful budgeting tool where you can actually pick how much the budgeted amount for your repair items are. You can choose how long it's going to last for, which will determine the monthly cost. So for example, we just have working capital here, $2,000. The month start is 1, month end is 1. So you can see the 2,000 would all flow out in month 1. If you change this to 4 months, for example, you can see then that 2,000 gets divided by 4, and you're going to be paying $500 a month in working capital. I'm going to put that back at 1. This is much more powerful and useful when you're doing a fix and flip or fix and hold scenario. Then we get into the operating summary. So this is where you're going to make all of your operating assumptions. You can see up here, I enter the rents in. So I think when I purchase this duplex, I can charge $1,300 and $1,200 for rents. And there's also shared laundry where I'm expecting a $30 a month income stream. You can make assumptions either on a monthly or annual basis. And then in future years, you can do it again on a monthly, annual basis, or you can just do a percentage increase over the previous year. So what I do is I set the rents at $1,300 and $1,200, and then I'm just doing a 3% increase in year 2. That's months 13 to 24. These months populate automatically, so you'll know exactly where you are in the pro forma. And then in months 25, which is the beginning of year 3 through the end of the pro forma, year 10, I'm doing 3% rent growth thereafter and 3% laundry growth. Expenses are very similar. You can make your expense assumptions either on a monthly basis or on an annual basis. You can see I'm doing admin $300 a year, but on the utilities, I'm doing a monthly assumption. Management fee is a little different. You'll notice all the text is black. If it's black text, that means you don't need to touch it. You'd actually do the management fee over here. So if you, for example, thought you wouldn't need a manager, you're going to self-manage it, you could just type in 0%. And then the management fee would be zeroed out. The economic loss, this would be your vacancy or concessions. 5% is pretty standard. You'd control that up here. So if you wanted to move it to maybe 8% year 1 to make it more conservative, 6% in year 2, and then 5% thereafter, that's how you would do it. One useful little tool that I included is for if you ever purchase a property where you inherit leases. Now let's say the property is rented, it's a duplex, but both units are way under rented. And you would have to inherit those leases. So the day you close on the property, unfortunately, you're not going to be able to get an attractive rent. You're going to have to wait the leases out and receive that below market rent until the leases expire. So if you needed to adjust that, you could come down here and let's say rent one, we're solving for $1,300 and $1,200. But let's say unit number 1 is only rented for $1,000 right now, and unit number 2 is only rented for $900. And unit 1, the day you close, it'll still have 6 months left on the lease. So you're not going to be able to raise rents for another 6 months. And then unit number 2 has 8 months left. So you type in how many months are left, and then you can take your pro forma rent. So what do you want to charge when those tenants, those inherited tenants are out of there? Well, $1,300 and $1,200. And then you can see the model will automatically calculate a blended year 1 rent. So this is taking 6 months at $1,000 and 6 months at $1,300. So it's $1,150. That's that middle point. And then the blended rent for unit number 2 is taking 8 months at $900 and then 4 months at $1,200. And then most people, once you get the rents up to where you think they're appropriately priced in the market, maybe you'll just do a 3% rent growth thereafter. So this doesn't tie to the assumptions above. You just need to grab them from below. So I'll just hit equals here, grab the year 1 blended. I'm just going to drag that down. And then again, year 2 is blended as well. So I'm going to grab that from column J. I'm just going to drag down. So now the model reads, right? You can make a monthly, annual, or a percentage increase assumption. The model reads from left to right. So it's going to read this 1320 and it's going to ignore this 3%. But just to make sure it's clear, make sure you only have one entry per row. So now we only have the monthly rents. And then after, we're going to be doing 3% rent growth. And you can be certain that everything is correctly inputted. So if you scroll over all the way to the right, everything is nicely summarized over here, and you can see your NOI over a 10-year hold period. The stabilized assumptions are also summarized nicely as well in this middle section. I tend to hide this section once I'm done using it. And then if you go to File Print, everything is formatted nicely, ready to be printed, put in some sort of investment materials, or you can show it to your partners or investors as well. So the first page is the assumptions you're making, the summary of stabilized assumptions, and then the 10-year operating cash flows. So we go back. There's a charts tab. This is just storing some of the charts on the investment summary tab. You don't need to do anything with these. You can just ignore it. I'll actually just go ahead and hide this tab. And then finally, we get into the turnkey return metrics. So this is just a really nice summary of the various return metrics. You can see it goes from the NOI, which is flowing in from the operating summary. That Capex, that's what we entered in for working capital on the Capex Plan tab. Then we get into the debt service. So the debt service, we entered in our terms in the conventional financing section in the investment summary. And then it will show the acquisition information. Remember, the residual value, we plugged in a 2% annual appreciation factor on the investment summary, and also a 6.5% cost of the sale. You can see the finance, the principal of the loan ticks down over the years. So the longer you hold it, the more principal you'll pay down, the more equity you'll see when you go sell it one day. And then all the IRRs are summary. So they really start to increase nicely once you get into the 4th and 5th year. The equity multiples are summarized as well. And then you have the all cash return and the cash on cash return. I always include the non-levered metrics. So for example, the all cash IRR and the all cash return, it assumes that you're buying the property without any debt. You're literally putting 100% of your own cash into the deal. And it's important to compare the two metrics to just make sure that debt is accretive and that you're getting extra yield for the leverage you're putting on the property. That's just a pet peeve of mine. If for whatever reason you didn't want to look at the all cash IRR or the all cash return, you could just hide the rows and the all cash equity multiple as well. And then finally, the last tab, this is just the amortization table that stores all the debt information. You can open up this little plus sign here. These are the financing cash flows that are flowing into the pro forma. There's nothing you need to do here. It's just where all the financing information is stored and calculated. That wraps up the summary of the turnkey financial model. Make sure you tune into the fix and flip and fix and hold. That model is a little more complex. It takes into effect potentially using a hard money lender or a construction loan on your financing when you're doing the renovation. It'll also include a refinance if you decide to hold the investment and you need to blow out that construction loan or hard money loan and put on traditional bank or agency financing. And there's some good analysis in there as well, just comparing whether it's a better deal for you to fix and flip or fix and hold. Hope you enjoyed the video. If you have any questions, feel free to send me an email, and don't forget to check out the other video as well. Have a great day.